What makes a day historic in the world of finance? The Dow Jones closing above 37,000 for the first time ever certainly qualifies. The financial world was abuzz on Wednesday, as the Dow Jones Industrial Average did something it had never done before. It reached a record high, closing at a historic 37,084.78. This surge was largely spurred by the Federal Reserve's decision to maintain unchanged interest rates. But that's not the only factor at play here. While the unchanged rates were a significant catalyst, the anticipation of deeper rate cuts in the coming year also had a hand in this record-breaking event. This anticipation led to a surge in growth stocks, particularly in the tech sector. As they say, as one door closes, another opens. Or in this case, as Treasury yields declined, growth stocks soared. It wasn't just the Dow Jones that had a good day though. The S&P 500 wasn't far behind, rising by 1.4%. And the Nasdaq Composite, well, it reached an all-time high with a 1.4% jump. Quite a day, wouldn't you say? But let's get back to the Dow Jones. In case you're wondering what propelled this historic high, let's delve a bit deeper. The Federal Reserve, in its third consecutive meeting, decided to keep interest rates steady. This decision hinted at a faster-than-expected cooling of inflation, potentially paving the way for rate cuts in the next year. This combination of steady rates and the promise of future cuts set the stage for the Dow Jones's record-breaking day. And it wasn't just the Dow Jones that benefited. The financial markets as a whole saw a shift, with traders' expectations of a Fed cut in March rising to 60%, up from 40% the day before. So what does all of this mean? It means that in the world of finance, a day can be just a day, or it can be a day that makes history. And on this particular Wednesday, the Dow Jones did just that. It made history. And just like that, a day in December becomes a part of financial history. Behind every great surge, there's a decision. In this case, it's the Federal Reserve's decision to keep interest rates steady. The Federal Reserve, the central bank of the United States, is a key player in the financial world. Its decisions can send ripples through the markets, affecting everything from the price of your morning coffee to the performance of your 401k. And one of the most critical tools at its disposal is the ability to adjust interest rates. In its most recent meeting, the third of its kind in a row, the Federal Reserve made the decision to maintain the status quo. Interest rates were left unchanged, a move that was widely anticipated by market watchers. But what made this decision particularly noteworthy was what it hinted at for the future. The Federal Reserve suggested a faster-than-expected cooling of inflation. This could potentially pave the way for rate cuts in the coming year. In fact, Fed members projected a benchmark rate of 4.6% for the next year. This suggests the possibility of not one, not two, but 3 rate cuts in 2024, down from the prior projection of 5.1% or 2 rate cuts. This decision has caused a stir among traders. Their expectations of a Federal Reserve cut in March have risen to 60%, up from 40% just the day before. This shift in expectations is a clear sign of the market's reaction to the Federal Reserve's decision. But what does this all mean for you? Well, lower interest rates can stimulate economic growth. They can make borrowing cheaper, encourage spending, and can lead to increases in asset prices. On the other hand, they can also lead to inflation and erode the value of savings. So as we look ahead to the coming year, we're left with a question. Will the Federal Reserve's decision lead to a boom, a bust, or something in between? Only time will tell. The Federal Reserve's decision sets the stage for a potentially interesting year ahead. In the wake of the Fed's decision, Treasury yields took a sharp decline. Let's delve a little deeper into what that means. Treasury yields are the returns on investment that investors get from buying government debt. When the Fed keeps interest rates steady or hints at future cuts, it often leads to a decrease in Treasury yields. Why? Because lower interest rates can make newly issued bonds less attractive to investors, leading to a decrease in demand and consequently, lower yields. Following the Fed's latest meeting, the 2-year Treasury yield fell a substantial 28 basis points to 4.447%. Meanwhile, the 10-year Treasury yield dropped 19 basis points to 4.024%. These declines are not insignificant. They suggest that investors are anticipating lower returns on government debt, which can have a ripple effect on the stock market. Now you might be wondering, how does this connect to stocks? Well, when Treasury yields are low, stocks often become more attractive. That's because the lower returns on bonds can push investors to seek higher returns elsewhere, often leading them to the stock market. Consequently, the decrease in Treasury yields could potentially lead to further gains in stocks, especially if this trend persists into early 2024. But let's not forget about producer prices. In November, these remained unchanged, indicating a disinflationary trend. Disinflation is a decrease in the rate of inflation, which means the pace at which prices are increasing is slowing down. This could be a sign of economic stability and might impact interest rates and, by extension, the stock market. So what we're seeing here is a fascinating interplay between the Federal Reserve's decisions, Treasury yields, producer prices, and the stock market. All these elements are interconnected, influencing and being influenced by each other. These factors provide a hint at what's to come in the financial markets. We'll continue to monitor these trends closely, as they will undoubtedly play a significant role in shaping the financial landscape in the months ahead. Meanwhile, in the corporate world, developments continue to shape the market. Pfizer, a prominent player in the pharmaceutical industry, witnessed a notable decline in its stock value. This drop, exceeding 6%, was primarily driven by a sales forecast that fell short of expectations. The root cause? A decrease in demand for COVID vaccines and treatments. As we move towards a world where COVID is less of a threat, the market is adjusting to this new reality, and Pfizer's performance is a clear reflection of this shift. Southwest Airlines, a major figure in the aviation sector, also experienced a dip in its stock value. The culprit behind this downturn was the rise in fuel costs, a factor that directly impacts the profitability of any airline. As fuel prices surge, profit margins shrink, causing investors to reassess their positions and, in some cases, pull back. In the realm of the auto industry, Tesla, a company synonymous with innovation and disruption, faced a similar fate. A vehicle recall drove its stock prices down, reminding us that even the most revolutionary companies are not immune to the realities of the market. Recalls can be costly, both in terms of immediate financial impact and potential damage to a company's reputation. In Tesla's case, this recall served as a speed bump on its journey, causing a temporary dip in its stock value. These developments remind us that the market is a dynamic and constantly changing entity. Each company, regardless of its size or industry, is subject to the same economic principles and market forces. As investors, it's crucial to stay informed about these corporate developments, as they can significantly impact the performance of our portfolios. While the macroeconomic environment shapes the broader market trends, these micro-level events can create ripples that lead to significant shifts in individual stock prices. In the end, the market is a complex tapestry, woven together by countless threads of corporate developments, economic indicators, and investor sentiment. Oil prices are always a factor to be reckoned with. In recent developments, oil prices have seen a significant surge. This rise can be attributed to a greater than expected fall in US crude inventories. In fact, the week ending on December 8th witnessed a decline of 4.3 million barrels, a stark contrast to the anticipated decline of 650,000 barrels. This report from the Energy Information Administration follows several weeks of strong builds, tempering the upside momentum. So, what does this mean for the market? Well, it's quite straightforward. As oil prices rise, it can lead to higher expenses for businesses, particularly those heavily reliant on oil for their operations. This can squeeze profit margins and potentially impact stock prices. Furthermore, higher oil prices can contribute to inflationary pressures, another critical aspect for market participants to consider. The oil market, as ever, remains a key player in the financial landscape. So what do all these developments mean for the market? Quite a lot, in fact. We've seen the Dow Jones breaking records, closing above 37,000 for the first time in history. This was largely spurred by the Federal Reserve's decision to maintain unchanged interest rates, hinting at a potentially faster than expected cooling of inflation and the prospect of deeper rate cuts on the horizon. We've also noted downward shifts in Treasury yields, which are expected to persist into early 2024, offering potential for further gains in stocks. Amid all this, various corporate developments have been unfolding, from Pfizer's stock decline due to a lower than expected sales forecast, to Southwest Airlines and Tesla facing stock declines for reasons such as increased fuel costs and a vehicle recall. Even external factors like the fall in US crude inventories, leading to a rise in oil prices, have played a role. As we move forward, these factors will continue to shape the dynamics of the financial markets.